Okay, everyone. Good morning. It's about 9:45 Eastern Standard Time, June 19th, Tuesday. Last night's trade that I was looking for did manage to get triggered, and this is just one of those things. You can remember I was looking for the market to break up above these highs. The breakout actually happened fairly late in the U.S. session. Actually coming into the Japanese session. You can see then right here, this is about 1 o'clock, I think 2 o'clock in the morning. The market did manage to spike up, but then came back down, not too coincidentally, right into 98.23, 98.22, right into the area that I was talking about in the video. And then, of course, you can see the resulting move up. Now, let's go down to a 15-minute. And we'll talk about a couple of things here, and then we'll also talk about a couple of trades that I've been talking to other members about over the past week. My reasoning behind setting the stop where I did had to do with the market action here, and then the reason why I left it in place was how the market was reacting both here and here. Because if you remember, I put out yesterday's video fairly early. When I came back in the market, I saw that there was some support building in this area here in the marketplace, these two lows. And then I saw that coincided fairly evenly with these prior highs there. So I felt confident that the market would have a difficult time getting through this area and then down to the stop. But you can see how placing smaller stops is not more conservative. It's actually more risky. Especially if you're talking about automated trades. If you remember, the stop was only about 25 pips or so, I think, and that can get a little bit tight. So let's talk about stop placement and some other things. Remember, one of the criteria, the two criteria that I have for a stop is number one, it needs to be close enough that I can afford it. In other words, I don't want to place a stop down here at 97.70 if I don't have that much money in my account. And then two, it should not be easy for the market to get to. And this is a bit subjective and ambiguous. So let me talk about that. And by subjective and ambiguous, I mean, what do I mean by not easy? Not easy to me might not mean the same thing to you. So let's look at it in terms of the markets. Remember I was looking at the lows right here, and then the highs there. The thinking goes, if this area was resistance, meaning traders sold the market when it got up here, and then they bought the market when it got there later on, obviously the opinion has changed. So the theory is then, if the market pushes back down into this area, then the likelihood is that the market participants are going to buy if the trend is going up. Okay, that's the key thing, if the trend is going up. And the short-term trend has been going up. Now, in terms of easiness, I mean, if you think about it, doesn't it just make sense that it would be harder for the market to get back down into this area than it would be for the market to get down in this area? I mean, if you just think about it in terms of dollar terms, the market gets up here to 98.45,